Hello, can you hear me? Hello, can you hear me? I'm not sure if anyone can actually hear me.
I hear you, Michael. Good morning.
Oh, thank goodness. Okay, cool, man. Thank goodness. Okay, that's cool. Thank you, thank you, thank you for coming. Um, I'll let the people kind of sign in. I'll give a couple of minutes. My hope is I've tried to kind of split this up into two parts. So I'm kind of hoping to provide in today's session some kind of like theoretical thinking. I'm going to go through a few different layers of some kind of theoretical thinking about investing. And then my hope is that next week, I'm going to kind of talk about some more practical aspects of this in terms of diversification and how to think about setting up your portfolios, your own personal and etc. So the way that I've kind of attempted to structure this is I'm going to kind of go through and provide three different types of biases that I think we all know about, but it's just kind of really helpful to think about them in a practical manner. And yeah, I'll just kind of hang around for a couple of minutes just to make sure, like I'll give it another 1 or 2 minutes if anyone is signing in late. Hi, Budimpa. How you doing? You okay? Hello, can you hear me?
Oh,
Hi.
me, sorry. Yes,
That was
yes.
not bad pronunciation. I did try Budimpa. I tried.
Bo, just Bo's good enough.
Bo, sorry. Bo.
That's okay. That's okay. Yeah, all is good. Sorry, I haven't been able to join.
No, it's fine. It's fine. It was summer as well. A lot of people kind of off and on. I don't know about you if you have family, etc. But you know, with family and holidays and stuff like that. Yeah, a lot of people kind of moving around. So yeah, I think we could. I think we're gonna kind of make a dent, and we'll see how we go. Okay, so I'm kind of excited about this. So as I said, I'm kind of the way I've structured it is I'm gonna go for three biases that I'm hoping that you know that are helpful at this point in time. So the first thing that is quite important to think about is that you know I'm not a believer that when you're investing that someone else knows necessarily more than you about a stock. Okay, so at times the market can be really volatile, and in those periods, you know, you kind of have so much doubt, and it drives you crazy. And the way that I kind of was thinking about this was in this manner. So let's say hypothetically you spend a bit of time, you do some research, and you buy your property, you buy your house, and you spend, let's just for the sake of discussion, you spend like $1 million buying up your house, and the next day,
So it'll be easier to.
sorry, I'll just mute somebody. Someone's looking.
You froze there for a bit.
Sorry. Am I back on?
Uh-huh.
Okay, fine. Thank you for telling me. Thank you. Because yeah, I didn't realize. So let's just say, for the sake of discussion, that you bought your house, you did your research, you looked at the neighborhood for quite some time, and you're familiar with the area. You kind of know like the good and the bad aspects of the property. You know what the street looks like, what the neighbors look like. You kind of, you know, you've done your due diligence, and you pay $1 million for this house, and you kind of, okay, like the property is worth $1 million, and the next day, the real estate agent comes around and says, oh, you know, property prices have crashed, and the property that you're in and your neighbors are only worth 750K. Now, instinctively, you feel like bad. You feel like, you know, you kind of made like a bad decision, and that now it's selling at a bigger discount, and you kind of feel distraught, and you kind of spend a little bit of time soul searching. But because you've spent some time doing all that research, you've made your own independent analysis, and you're able to go back to that independent analysis and say, no, doesn't matter what that expert is telling me. I've spent a bit of time, I've researched this, I've been in the street, I've spoken to the neighbors, I am familiar. Maybe it's not worth $1 million, maybe it's worth a little bit less, but that figure that this expert has put out for me, it doesn't make sense. This is just, it's not realistic. So what I say to everyone, and I know it's like investing is a full-time job, unfortunately, and I'm in a privileged position that, you know, I do this full-time, but even if you're not, I always say, listen, when you buy a stock, just write 3 bullet points of why you're buying it. You know, it's not just because you kind of an expert that said something or other. Write down 3 bullet points. They don't need to be really long. 3 bullet points is like, I don't know, maybe 5 minutes, 10 minutes max, right? Really, because you've done all that research into why you're buying the company. You're not just buying the company because someone said on CNBC, oh, the stock's going up, blah, blah. You're trying to really spend a bit of time doing that research. So it's already there. You've already done the work. You might as well just write 3 bullet points and invest those 10 minutes. And I recommend, that's what I do, but I recommend you just put it up on an Excel spreadsheet or somewhere on Google Cloud. So you can just search, you can have it with you, you know, on your mobile, and you don't need to do much more. You just write those 3 bullet points. But the criteria that I give to people is when you write those 3 bullet points, do not talk about the valuation, because valuations change, and you may say, okay, you know, it's looks cheap because it's like, oh, it's really like it's so cheap, it's like price at 2 times earnings. Like, that's a distraction. I feel that if you're going to write the 3 bullet points, you need to think about what the business's prospects are going forward into next year. So don't spend too much time kind of, just like, oh, it's cheap because my company is cheaper than the peer over there. That's not very helpful. Try and think about your business's prospects over the next 2 years. Think about, you know, what are the different dynamics that are going to move this business. You don't need to make it overcomplicated, and I'm making it sound quite complicated, but it doesn't need to be. So for like, as an example, right? So if you're looking at, let's say, software business or something like, I don't know, a Google or something like that, you just try and think, okay, it has 2 or 3 different revenue streams. It has like the search, it has the YouTube, which is kind of different, and then it has this kind of cloud, and it has this kind of other thing called other bets that may be something, I don't know. But don't make it really complicated. Just kind of think, okay, like there's a search business, and it's like kind of like a monopoly, kind of, and you know, just make it really simple for you, because even the best businesses in the world, from time to time, will be down 30, 40, 50% in a year. And you don't want to be caught out in that period and kind of like, oh, you know, like everyone is, because all the bad news surfaces when the share price comes down. When the share price is going up, nobody's saying anything, and everyone is singing and dancing, and everything is good, and everyone's happy. But when the share price starts to come back down, that's what I call like the difficult questions surface. Everyone comes up with like really difficult questions, and they're so silver-tongued, meaning that like those questions are so like the meaning of meaning and highfalutin and put across in a way that really kind of scares you. But you know, like, that's life. Life is a lot more cyclical than people like to believe it is. There are, you know, like your own health, there are periods of time where you're kind of high and flying and you're going to the gym, and there are periods of time where you don't feel like it, you know, like things happen in your life, you know, you didn't sleep or whatever. Like, and we as investors have been indoctrinated, particularly in the last 10 years or so, into believe that everything is a secular growth business. Everything is like the next Tesla, the next Amazon, the next whatever. Because we went through a period where all these kind of mega cap businesses became so massive and untouchable. And we kind of got a bit confused in this period, I believe, that we believe that the next 10 years, it'll also be that same story. But businesses are actually really, really, you know, cyclical. You can see that, for example, I'm not picking on Amazon, just the one on top of my mind. Like, it has its e-commerce business, and that e-commerce business is kind of like, you know, it's doing okay, but it's kind of falling quite a bit prey to the competitive forces in the market. There's like so much people, so many businesses kind of trying to chip away at its market share. So capitalism is really brutal. It doesn't sleep, and you don't want to be facing that moment of doubt at the worst possible time. So don't make it too difficult. I believe that investing should be really, really simple, and anyone that tries to overcomplicate it is doing themselves a disservice. So I'm just going to give one more example that is helpful to me, and I would hope that it's helpful to you people as well. When Buffett made the investment in Coca-Cola, he was just looking for the volume of cans being sold of Coca-Cola going up over time, and the number of shares outstanding coming down over time. So something that's really simple, like you can, it's quite simple. And the irony of all this Coca-Cola's investment, the story is that I'm not 100% accurate on this, but you can kind of take this in the right ballpark, at least directionally correct, that since about the year 2000, more or less, Pepsi has actually outperformed Coca-Cola by a reasonable stretch. So even like the world's best investor hasn't really, picked what turned out over the next 20 years to be the best investment. But because he had this simple formula that he stuck to, anyone that is compounding at levels of, say, 7%, 8%, 10% is going to do really well. Like the problem with investing is when you have these periods where you're up 20%, and then you're down significantly, and that's the problem. But, I say to people, it doesn't sound exciting, and I'm always trying to explain this, like it doesn't sound as exciting to do the slow and steady, but the slow and steady, it's a cliche, but it does win the race. And when it comes to investing, the best advice, I believe, is to think about this, right? Let's pretend you today, like you have whatever you want to be, like 100,000 or 1 million or whatever number, like you've made it, okay? And when you invest, you're not investing to make more money, you're investing to keep that money. So that is a difference of night and day, because I say, like in the market, everybody can make money, but very few people can keep money. And that's really the key. You want to be able to come back to play tomorrow, and you don't want to have, where everything blows up and you're basically back to scratch, because it sucks, right? It really sucks. And you need to kind of position your portfolio to have stamina. And by that, I mean, you need to have like different types of ideas in the portfolio, different types of diversification that allows you to remain sane when certain aspects are not doing very well. So I own this company, Arch Resources. It's a commodity company. It's not the most sexy business, and I know that. I know it's not the most sexy. It's a coal business. They sell coal, metallurgical coal, that is used to make steel. It's really boring. I get that, but it's kind of kept me sane because it did go down a little bit. It's kind of ticked back up and has a very large dividend. That's why I kept with the stock, because it had such a the dividend isn't guaranteed. It's not one of those kind of it's not like one oak that is OKE, the stock OKE, that kind of quote unquote guaranteed to give you a 6% dividend or 5.5, whatever. It's not that. It's kind of like you don't know how it's going to be next 90 days because you're always dependent on the coal prices. But through their buybacks and their dividends, they're making at least 10% return, if not 15%. So you're getting a really large yield, and that's why I stuck with it. It's not a guaranteed dividend or yield, but it allowed me to stay sane. So I'll give the other side of the equation. So I invested recently in Broadcom, and Broadcom is like a cheap stock, and this whole narrative of AI seems to have taken kind of a back step slightly, but because I had this commodity business, it allowed me to kind of remain with some sanity. So allow me to keep playing this game, because you just don't want to be in a position where everything's going down at the same time in portfolio and you're searching. That you don't want to have the moment of doubt at the wrong possible time. Okay, so that's the one that I wanted to wanted to explain. And now I'm going to kind of talk to the second part of my talk. So as investors, we are prone to feeling overconfident. And to make matters worse, there's so much data out there. You can look at the share price, you can look at the price to earnings multiple, you can look at the growth rate, you can look at the balance sheet, you can look at what the company's CEO has said on CNBC. I'm not picking on CNBC, but okay, like what the company's CEO has said, or there's so many different things that an investor can be looking at, and all that like data coming at you can lead you to feel overconfident, okay? And as investors, having more data doesn't actually translate into better quality information. Again, I go back to that story about Coca-Cola, when Buffett is just looking at those two variables. So he's just looking at the volume of Coke going up versus the number of shares outstanding coming down. So that's really something that you don't want to be in a position where you're just looking for more data and looking for the last little nugget of information that you believe that nobody knows. Now, at times, let's say that you're investing in like Microsoft or whatever, the person that's investing on the other side of the trade. So whenever you're kind of buying, there's someone else that's selling to you, and whenever you're selling, there's someone else that's buying. So it's a zero-sum game. Now, they know relatively the same amount as you. So you have to remember that. You don't know any more or any less than the other person on the side of the equation. So don't presume that you can say that I know more than them. So just think that it's quite important when it comes to investing to give yourself the room for error and to say, okay, we as investors, it's a very aggressive sport, and we have a tendency to make ourselves feel like overconfident. And on the other side of that is that if something isn't working, I believe it's quite important for you to go back to your 3 bullet points and look to see if the thesis has broken down. Now, in most cases, the thesis will not break down in, let's say, 3 months or 6 months, okay? So in most cases, I would say stick with the business for at least a year. I have this kind of rule that I really don't want to sell a business for less than a year, because in that year, it's anyone's game. It can go up, it can go down. The Fed has said this, the Fed has said that, and like the market's going to be crazy. And, after a year, you can reassess your position. You can say, okay, this is what I thought. This is my 3 bullet points, and my investment thesis isn't working out. That's fine. Like there's the famous Ray Dalio quote that I'm a professional mistake maker. A third of my trades are probably wrong. So it's the cost of doing business. You're investing, there are going to be failures. That you need to have a process in your mind to deal with the failure before you buy into the stock. So the way I think about it is that when you write your 3 bullet points, go into the vision that, it from this point onwards, what it's done last week, last month, last year, doesn't make any difference. It's from this point onwards, looking forward over the next, let's say, 2-3 years, what are going to be the main drivers of the business, and what am I going to do if things are not working out? What are the key criteria that I'm looking at? If possible, I try to look at the customer adoption rates. It's not always possible to find those, but if you're looking at a tech business, try and figure out that of some measure. Don't rely too much on the revenue growth rate, because that can kind of be skewed from quarter to quarter if pricing goes up, or if the business is being a bit kind of playing around with the number of customers that they're onboarding. Don't try to kind of get too caught up in that. Look at the customer adoption curve. I think that's something that most tech businesses will give you, so that you can kind of get some granularity into that. Okay, and part 3 that I'm going to talk about today is the final part. It's last week I talked about Michael Mobosin from Credit Suisse. he's written quite a few books on this, and I think that you don't need to spend a lot of time reading through his stuff, but you just have to kind of become familiar with the fact that the vast majority of businesses do not grow at 30% compounded for a period of 5 years. The vast majority cannot even grow at 30% compounded for 3 years. It's, according to him, after going through more than, I think, it could be 5,000 different stocks or something, approximately 2% of companies, publicly traded companies, compounded 30% or higher for a period of 3 years. So if you think about that, those businesses like Amazon or whatever are anomalies. Those are very few and far between. If you look at thousands of businesses, the vast majority will not grow at these high compound rates. And I think that if you start at that basis, because when you're kind of looking at a growth business, start to the basis that that growth will be fizzling out in a relatively rapid period. Businesses that grow at scale at 30% or higher are extremely rare. Now, the other side of that equation is that a business can grow at a slow rate, let's say 20% or 15% for a really, really long period of time. So the 30% is difficult. You know, you're having to really perform a lot of miracles. You have to kind of be hiring a lot. You have to build out a lot of infrastructure. You have to get all the customer distribution in place. It's really difficult to do that. But to grow at a slower and steadier pace is relatively easier. And provided that you're not paying a lot for that slower growth, that can be a nice fertile ground to kind of dig around and think about. Yeah, I think that's pretty much everything I wanted to cover. I don't have other aspects to cover. If anyone wants to kind of ask a question to kind of from whatever I said, if anyone's interested.
I think what you say makes sense. Yes. Because I just had a conversation with my husband last night. We were driving and he's like, oh, you know, he just hears bits and pieces. He doesn't get involved. And some friend said, oh, Nvidia is going to crash. Remember the day before their earnings came out? And he's all panicked. And so I said, no, I explained. And even last night it was Apple, because he read on Google, on Yahoo, some guy was saying how Apple's going to crash and they're losing business here and there. And I think unless you know the details of, you know, because China, he's like, China's not using, it's like, not China, it's just the Chinese government employees, and it's 1% to 2%, and it might be 6 pennies on their earnings. And all of their other businesses. I explained all that to him. And it like you say, it's just a quick, you know, their income streams. Mm-hmm. And so he was a little more calm after that. So, so I do have to think about those things to explain to him.
But also, you know, yes, expectations are important, but you also have to remember that a lot of analysts make a name for themselves by selling fear, right? So if you're kind of going into the earnings result, if you have an outlier view that's often quite negative, it allows you and your firm to kind of surface on the run up to that, on the days running up to that. You put an analyst report saying that, oh, the stock is going to miss, blah, blah, and it kind of drives engagement back to the firm. That not saying that that's not possible, that Nvidia could crash. There's not saying that, you know, I'm not saying any of that. It's possible. It certainly is possible. But it's important to add some context as well, and to just think about the person that's actually giving that information. What is the incentive? Like
some guy got on CNBC the day before Nvidia's earnings were coming out. Just he's saying, like, I don't know what basis he used, but his friend heard this and told him, and he freaked out, because we have quite a bit of Nvidia, just because I've been buying it over the years. And so it's scary, and if you don't know. And I do try to read a lot and stay informed, especially with the companies I buy. So I don't panic, but
But
it's
it's,
easy.
I don't have any position in Nvidia. I don't own the stock. I don't really, react. Not too worried. But I would just say, as I said, you do whatever you want with the stock. I'm very happy for you. You've done really well there. But those expectations are high. Remember that. Okay, that's what I'm gonna say. The expectations for Nvidia are really, really high.
Right.
Just keep that in mind, okay? That's all I'm gonna say. Like,
No, I do fall in love with companies like Apple. I've had Apple, I've had Google, certain companies I just love them because I use them. Like we were saying, I've got Apple, I'm on Apple, it's just me, one person, and it's just all over the world. Everybody's on Apple,
well, admittedly, I also am on Apple. That being said, just because you are on Apple doesn't mean realistically that the rest of the world is on Apple, because there's a lot of competition. First of all, there's Samsung,
Yeah.
there's Huawei, there's like 1 billion people in China that being targeted with other consumer electronics. That's the first thing, and they have also quite a lot of money as a collective, not on a per capita basis, but as a collective, they have quite a bit of money. The other thing that I would say is that what you own doesn't really make a lot of difference if you think about it, because as I said, I don't care about Apple. I have no position in these stocks. We're just discussing. We're just kind of talking backwards and forwards. I don't have a position here, and I'm not trying to dissuade you. And don't shoot the messenger. But when you think about, for example, I like Apple. So I mean, the stock. I don't care about this. I have a phone, but I'm gonna ditch this phone. I want to go back to something else. Doesn't matter. But the stock I like. I think that the expectations are relatively reasonable there. With Nvidia, man, they really need to pull something out of the hat over the next 2 quarters, and that because at 60 times forward sales, yes, I know, that the revenue was up 100% last quarter. I know that, but that's all pricing. I don't know how you said you've been with Nvidia for a long time. In 2017, when the crypto markets were exploding, yes, it turned out there was like another leg to Nvidia's bull market, which turned out to be AI. But you also remember, if you go back to 2014, that Jensen Huang was talking about how in 2021 everyone will be on driverless cars, and that Nvidia's GPUs be servicing that. Now I'm in 2023, and to my understanding, that hasn't worked out. So it's very easy when the share price is going up for us to fall in love with the narrative. And I'm not trying to dissuade you. I seriously have no position in this. We're just talking, right? But I just think that it's important to kind of. So I think that Apple's valuation is more reasonable. I like that.
Yeah.
But Nvidia, I think that
Yeah.
Be careful. I'm not saying that your husband is right. I'm not saying he's wrong. I'm just saying, just it's okay to be the devil's advocate and for you to kind of say, you know what, here's another example with Nvidia. So if I go back to February this year, I think it was February, yeah. So just before they had that their analyst day, just before the revenue growth rates that they had, just before the analyst day that they had, the analyst expectations were that they were going to have no growth for the next 2 years. It was like flat, like this. Let me show you, like this. There was no growth whatsoever. And then this thing came out. People have said, I don't have any opinion on this, people have said that China has been buying a lot of GPUs. Now, everyone talks about China, and China's like this magic black box that everyone kind of likes to kind of put in one way or another to build whatever rhetoric they want to build, whichever way it goes. But that the expectations from the analysts were flat. And when it comes to those GPUs, they just spiked, Nvidia has just spiked up the pricing, and they have a limited amount of time to really excel with that market share. Because, AMD is coming out with something. There is within, for example, Broadcom, they also have their own versions. Obviously, in the last several days, Tesla's Dojo has come out. So there are already some companies trying to kind of chip away at that. So I'm not saying that Nvidia's ecosystem, and if Luke was here, he'd be basically giving me a hard time because he's like the biggest Nvidia bull. But I'm just saying that it's important to have some kind of, it's okay to check yourself. Yeah.
Yes, okay. Okay, thank you for that warning.
Sorry. Does anyone else want to chip in with something? Does anyone else want to ask any questions?
Hi, Michael. This is Pearly. Can you hear me?
Hello, hi. How you doing? Thank you so much for coming. Thank you. I appreciate that.
Yeah, thanks for the call. There's something wrong in my camera, so I'll
That's
just
fine. That's fine.
not have the camera. Yeah.
That's fine.
Anyway, I was just wondering, you said that you would cut loss beyond 20%, right?
Mhm.
Is that rule also with your 1 year timeline? Beyond 1 year?
So if
What have you done in the past? Yeah.
I
Go
have
ahead.
tried my best to give the businesses some wiggle room over 20%, 20, 25%, or a year time frame. A few select opportunities that have not done that. For example, Uranium Energy Corp and Antero, which I so strongly believe in the story that hasn't actually come to light, that I haven't fulfilled that. So I've broken my own cardinal rule. But these are businesses that I believe that, as I said at the start, it's important to have staying power in the portfolio. So I've selected these businesses that have very strong balance sheets. So even if the share prices come down, I have said to myself, okay, I have picked out these businesses and I want to see them flourish. And I think that with Uranium Energy Corp and with Antero, two different operations here. One is uranium, one is natural gas. I think that they're just on the cusp of improving the outlook. They've been for a really brutal period, but typically I will try and sell out of those businesses that either have fallen for approximately 20-25% stop loss, or the year has kind of come to an end. Whatever I thought at the start didn't work out. I have to just be upfront and honest and move on.
Sorry, so you're saying it's one or the other, right? It's not both, correct?
Yeah.
So
Typically, I would like to hold on. Typically, the strong rule is 1 year. I'll give those businesses a year for the vast majority of the cases. If I see, however, that in a 6-month period that this, like, everything that I thought was completely out, I would revisit that. But I typically want to hold for a year.
no, but so let's say if the businesses is the stock goes down more than 20% within the year, would you
Yeah.
then discipline yourself to cut loss?
No. If it's just a share price coming down, I would not cut the loss. I would not. I will stay with it for the year. That's my hard rule. The year. But if I see that, for example, that I was expecting the business to kind of very slowly grow, but I can see that the business's revenues and profitability are just falling off the cliff, in that instance, I would just cut the business and cut it out of the portfolio. But just to summarize, the hard rule that I follow is the 1 year time frame.
Got it. That's clear. And I mean my personal experience, because I'm also, even though I was investing for the company in the past, in personal investing, it's quite different. But also because it's an absolute game, right? It's not really a relative game that I'm playing here, which is sometimes a bit more challenging when it comes to, market direction and so on. But I also feel that sometimes with technical analysis, which I employ, it's really complicates things. And I personally find that sometimes I feel like, I rather not look at chart. I mean, I can look at charts to see where we are relative to, say, a longer period of time. But if I'm looking at it just to like enter or exit, I find that sometimes I get very bad signals. And now with the markets, especially if you're trading stocks that are you're buying stocks that are very volatile, and markets are very volatile. It's not, you know, a few stocks can do a little bit a day sort of thing. You know, sometimes they have big drawdowns, sometimes they are a lot more volatile. I find that technicals actually are very distracting. And I'm trying to now unlearn some of the things that I used to learn in technicals. Yeah, just some feedback. Yeah.
So I personally, I'm not a technical person. I'm looking at the business, the underlying business. I don't focus on the technicals. I do have this kind of signal to myself of the 20-25% stop loss, because just as a kind of like a shake me up, like come on, what's going on here? But I am looking really at the underlying fundamentals.
Yeah, I understand that most of us will pick stocks that have fundamentals, right?
Yeah.
But deciding on when to buy and when to sell, I find that when to sell is probably a tough one as well,
Yeah,
as much as when to buy. And I find that when stock prices are very volatile, it is technicals can give you very wrong signals. That's what my point. Yeah.
So as I said before, try and space out the buying period over a 4 or 6 week period. No stock, no matter how good, goes up or down in a straight line. No matter how good the story, just give yourself time, because you don't want to be in a position where you're kind of going all in on an idea because it looks attractive, and then the market goes a bit crazy, and 6 weeks later you're like, oh my god, what happened? In a state of panic. Space it out, really kind of like 4 to 6 weeks, buy like a third of the position, 4 to 6 weeks, buy another third, so that you've been at least for approximately, let's say, a quarter or longer buying into that position. Space it out. A lot can happen in the market in a week, but over, let's say, 3 months or 6 months, things tend to kind of regulate themselves back up. Are you still there, Pearly?
Yeah, that's clear. Thanks.
Okay, everyone. I really appreciate you guys coming up. Thank you so much. I hope this has been helpful. If you can afterwards drop me some feedback to say what kind of things you want to talk about. You Tomas, you've been really helpful with that, kind of providing me some feedback. Really appreciate that. I'm going to kind of try my best to make these talks as kind of helping you think about investing as much as possible going forward. So yeah, if you can give me some feedback, I really appreciate it. Just drop me a line, and yeah, we'll take it from there. Thank you so much, everyone. I really appreciate you guys.
Thank you.
Thank you so much.
Okay, bye-bye.
Thank you, Michael.
Thank you very much.